Hi everyone, I'm Namrata and welcome to another episode of the Basics of Mutual Fund series that we have created for you. So in the previous video, we spoke about active versus passive funds. In this video, we're going to talk about all-season funds. So if you look at the mutual fund industry, it consists of about 44 mutual fund companies that have about 2,500 mutual fund schemes currently as of December 2021. If we look at different mutual funds which are available, it is very important for us to understand the different categories of mutual funds for us to be able to identify the right funds that fit our investment objective and the risk profile. So before we really move on to understanding the different categories of equity mutual funds, let's first look at the journey of equity mutual funds in India. Equity mutual funds are synonymous with mutual funds. The journey of equity mutual funds started way back in 1964, and of course it picked up pace once the private players started their operations. Some of the biggest funds that we have in the industry were started in the 1990s and early 2000s, and they were funds like HDFC Equity Fund, HDFC 200 Fund, or there was ICICI Approved Multi-Cap Fund, there was erstwhile Reliance Vision and Growth Fund, which is now Nippon, or there was Franklin India Prima Fund. Now, most of these funds belong to large cap, mid cap, or the biggest category in those days, which was diversified equity fund category. Diversified equity funds are also just referred to as equity funds as well. Now, diversified equity funds are funds which comprise of large cap, mid cap, and small cap, but the highest allocation is given to large cap. I think the biggest challenge in those days was that there was no clear bifurcation between large cap, mid cap, and small cap. And there was no cap or limit in terms of the number of schemes under each category that each fund house could have. So imagine a scenario where a big fund house would have say close to 2 or 3 schemes under each category, and how difficult it would be for an investor to really select a fund for himself or herself. Cut to 2018. SEBI has reclassified all the categories of mutual funds, and it has given a clear definition of what is large cap, what is mid cap, small cap, sectoral, etc. If you look at the image on the screen, you'll be able to see all the different categories of equity mutual funds that are available. In line with the portfolio building activity, if you look at all the equity mutual funds which are available, we could classify them into 2 simple categories, which is all season funds and seasonal funds. So all season funds are basically those funds which are relatively lesser in terms of volatility as compared to seasonal funds, and you could invest in all season funds at any market time. So some of the funds or categories that could fall into the all season fund category would be your large cap funds, mid cap funds, multi cap funds, flexi cap funds, ELSS funds, ETFs and index funds, which are basically your passive funds, and so on. SEBI has categorized large, mid and small cap based on market capitalization. Now, what is market capitalization? So market capitalization is basically the total value of all the stocks of a particular company. Now, all the companies that are listed on the stock exchange, be it BSE or NSE, are given a particular rank based on their market capitalization. So the stocks which are in the top 100, so 1 to 100 rank, are called as large cap. 101 to 250 are called mid cap, and 251 and beyond are called small caps. Large cap funds essentially invest a big chunk of their portfolio, which is about 80%, in large cap stocks. Mid cap funds invest about 65% of the portfolio in mid cap stocks. There's a general understanding that large cap and mid cap funds are relatively safer compared to small cap funds. So if you look at the market correction time, it is the small caps that will be the first ones to fall, or they'll be the fastest to fall as compared to large and mid caps. And in market recovery phase, it will always be the large caps that will recover first before any other category. Because of this, small caps are considered to be more risky or more volatile compared to large cap and mid cap funds. Because of this, small cap funds are placed under the seasonal fund category. Now, if you look at large cap funds, they are lesser in terms of risk compared to mid cap and small cap, and at the same time, they are more consistent in terms of returns over a period of time. Mid cap funds are placed somewhere in between large and small cap in terms of risk and return. Now let's talk about flexi cap funds. Now, an investor might think that I don't want to invest only in one particular category. Is there an option available where I can invest in a combination of all the categories or different market caps? And this is where the Flexi Cap Funds fit in. So your Flexi Cap Funds are basically a combination of large cap, mid cap and small cap stocks. So in a Flexi Cap Fund, they were earlier called as Diversified Equity Funds, or later Multi-Cap Funds, and now most of the funds in this category are called as Flexi Cap Funds. So Flexi Cap Funds are like your Dolo 650. Any type of fever, this is a generic solution that's available to you. So a new investor could look at starting their investments with Flexi Cap Funds because, Flexi Cap Funds are like a buffet meal option where you would get exposure to multiple stocks, multiple sectors across multiple market capitalizations. As the name suggests, Flexi Cap Funds are more flexible in nature, which means there is no defined allocation to large, mid and small cap. It is the fund management team that decides how much allocation should be given to large cap, small cap and mid cap stocks. But generally, if you see, there is a higher allocation given to large cap stocks in a Flexi Cap Fund. Now, if you see the table on the screen, that shows you the segment-wise breakup of HDFC Flexi Cap Fund as of December 2021. Now here, large cap is given about 75% allocation and mid cap is given close to 14% allocation. Now in the other table that you see, where it's a segment-wise breakup of UTI Flexi Cap Fund, where large cap is given about 64% allocation and mid cap is given about 27% allocation. So in the coming months, if mid cap stocks were to do well, in all probability, your UTI Flexi Cap Fund would do better than an HDFC Flexi Cap Fund, and of course the reverse is also true. Now let's look at multi-cap funds. So multi-cap funds again are a combination of large cap, mid cap and small cap, but there's a very clear-cut definition which says that in a multi-cap fund, 25% allocation should be given to large cap, 25% to mid cap and 25% to small cap. And the remaining 25% is at the fund manager's discretion based on his or her market view. Now, because there's 50% allocation given to mid cap and small cap alone in a multi-cap fund, multi-cap funds definitely tend to be more riskier compared to flexi cap funds, and therefore the holding period in case of multi-cap funds should definitely be longer as compared to flexi cap funds. Now, the next category that we're going to discuss is ELSS funds, or they stand for equity linked savings schemes. They're also called tax saver funds. Now, ELSS funds is a very interesting category. They also invest across large, mid and small caps. But the biggest benefit that ELSS funds provide us is that if you invest in an ELSS fund, they are eligible for tax deduction under Section 80C. Now, ELSS funds are also called as long-term equity funds. So the example that you see on the screen is a segment-wise breakup of UTI long-term equity fund as of December 2021. Now, ELSS funds have a lock-in period of 3 years, which means that you cannot redeem or withdraw units in the first 3 years of investments. Now, other funds or other categories of equity funds that invest across large cap, mid cap and small caps are your Focus 30 funds or value funds, etc. So the all season funds that we discussed were large cap funds, mid cap funds, flexi cap funds, multi cap funds and ELSS funds. Now the question is, why are these funds called all season funds? They are called all season funds because they carry lower volatility as compared to seasonal funds, which means you can invest in an all season fund at any market cycle. You don't have to worry about timing the market. You don't have to worry about when to invest, when to redeem. At the same time, all season funds are ideal for a new investor or for an existing investor, and they should be a part of the long-term portfolio of an investor. Now, for an investor, if you look at the equity portfolio, it could comprise of 70 to 80% of all season funds, and the remaining allocation could be given to seasonal funds. So basically, a higher allocation should be given to all season funds. Now, it is important for all of us to understand that no two equity funds or no two categories of mutual funds are the same. Every fund or every category carries different degree of risk. So which is why it is very important for us to balance out the risk and the return of a particular fund. So to start with, when you're building your investment portfolio, you should have a higher allocation to all season funds and look for funds with a good history and probably consistent performance over a period of time. In the next video, we're going to talk about seasonal funds. So if you've liked this video, do like and share it with your friends and subscribe to our channel, of course. And if there's any specific topic that you want us to cover related to mutual funds, feel free to mention it in the comment section. Also, please remember that we use a lot of examples in our videos, but we are not recommending or advising those funds. We are using those examples purely to explain a particular concept to you. Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.